In 2025, S&P Dow Jones Indices published the latest edition of the SPIVA scorecard, 25 years of data on how actively managed funds perform against their benchmark index. Here is the number from that report that should stop every investor in their tracks. Over the 15-year period ending December 2025, not a single U.S. equity fund category 0 out of 22 had a majority of active managers outperforming their benchmark. Not one category. Not for 1 year in that window. 0, and yet Americans hold approximately 47% of their equity mutual fund assets in actively managed funds. Nearly half of all invested equity capital is paying higher fees for professional management that the data says. Over 15 years, fails in every measurable category. That is not a debate about investing philosophy. That is a math problem. And by the end of this video, you will understand exactly what is creating that gap, what it costs in real dollars over 30 years, and the one situation where active management actually has a legitimate argument. Here is what we are comparing precisely because the framing matters. An index fund does not try to beat the market. It owns the market. A total market index fund like VTI buys every publicly traded U.S. company in proportion to its size. A large cap index fund like VU tracks the S&P 500, the 500 largest U.S. companies by market capitalization. The fund is not making judgments about which companies will outperform. It owns all of them. The expense ratio, the annual fee charged for this service, is typically 0.03 to 0.10% per year. On a $100,000 investment, that is $30 to $100 per year. An actively managed fund employs a portfolio manager often supported by a research team, quantitative analysts, and industry specialists who makes active decisions about which securities to own, when to buy and sell, and how to position the portfolio relative to a benchmark. The goal is to beat the index. The expense ratio for this service typically runs 0.50 to 1.50% per year. On the same $100,000, that is $500 to $1,500 per year every year, regardless of whether the manager beats the index or not. The premise of this comparison is straightforward. Both types of funds are investing in the same underlying markets. The question is whether the additional cost of active management paid up front year after year, compounding against the investor's balance, is justified by better performance. 30 years of data has produced an answer. Let's start with the SPIVA data, because it is the most rigorous long-term measurement of this question that exists. The scorecard accounts for survivorship bias, the misleading effect of only measuring funds that are still alive and excluding the ones that were shut down or merged because they underperformed. Survivorship bias is one of the most significant distortions in investment research, and SPIVA corrects for it. The numbers are real. At 1 year, 79% of actively managed large-cap U.S. equity funds underperformed the S&P 500 in 2025. That number alone should be jarring. These are professional managers operating at full capacity with every institutional resource available. Nearly 4 out of 5 underperformed a fund that does no research and charges 3 basis points. Extend to 3 years, 67% underperformed. To 5 years, 89%. To 10 years, approximately 90%. To 20 years, 93%. The SPIVA 2025 report covering the past 20 years found a vast majority of active fund managers wound up as laggards compared to their benchmarks, and the underperformance rates rose as the time horizons lengthened consistently in every category, across every period measured. The 15-year result is the one that matters most for this video's argument. After 15 years, there were 0 categories not in domestic equity, not in international equity, not in fixed income, where the majority of active managers outperformed. 0, that is not a slight edge for passive. That is complete domination across every asset class and every time horizon long enough for the fee drag to compound. And here is what makes this data particularly damning. These are the survivors. The funds being measured are the ones that made it to the 15-year mark. The ones that underperformed so badly they were shut down or merged are not in this data at all. The real underperformance rate accounting for all the funds that started during this period and did not survive is higher than what SPIVA reports. SPIVA's numbers are already the favorable interpretation. Here is the single most important sentence in this entire video, and I want you to hold it. The expense ratio is the only investment cost that is guaranteed regardless of performance. Markets go up and down. Individual fund performance varies. But the expense ratio is charged every year, subtracted from the fund's returns whether the manager beat the index or not, whether the market rose or fell, whether you made money or lost it. It is a certainty in an industry built on uncertainty. And certainty, compounded over 30 years, produces a predictable and enormous cost. Here is the math on what that certainty costs. 2 investors. Both start with $100,000. Both invest in funds tracking the same market with an 8% gross annual return. Investor A holds a low-cost index fund with a 0.05% expense ratio. Investor B holds an actively managed fund with a 1.00% expense ratio, well within the typical range for large cap active funds. At year 10, Investor A has approximately $214,000, Investor B has approximately $194,000. The gap is $20,000. Already noticeable, but the fee's real power has not yet arrived. At year 20, Investor A has $456,000, Investor B has $377,000. The gap has grown to $79,000, more than Investor B's original investment. At year 30, Investor A has $975,000, Investor B has $724,000. The gap is $251,000. $251,000. Lost to a 0.95 percentage point difference in annual fees before any underperformance. That is the fee cost alone, assuming the active fund matched the index gross of fees. In reality, the SPIVA data says it likely did not. Here is a number that should stop you for a second. Over 20 years, every zero. 5% in additional expense ratio costs approximately 10% of the investor's final account balance. That is not a projection. That is the compounding arithmetic of a fixed annual charge applied to a growing balance. The fee that sounds trivial annually becomes the defining variable over decades. The underperformance of active funds is not a coincidence, a bad run of luck, or a temporary condition that more skilled managers will eventually overcome. It is a mathematical inevitability rooted in a simple concept called the arithmetic of active management, first articulated by Nobel laureate William Sharpe in 1991 and confirmed by every major dataset since. Here is the argument in 3 sentences. All investors, collectively, own the entire market. Therefore, the average dollar invested in the market must earn the market return. After costs, the average actively managed dollar must earn less than the market return. The expense ratio is not a variable that skilled managers can overcome by being skilled enough. It is a structural drag on every dollar in an active fund every year before any measurement of performance begins. Think about what this means. Active management is a zero-sum game before fees and a negative-sum game after fees. For every active manager who beats the benchmark, another active manager must have underperformed by exactly the same amount because together they own the entire market and the average must equal the market return. The fee is then subtracted from both sides. The winners become modest. The losers become significant. And the index fund investor, paying no fee for active management, systematically captures more of the market return than the average active participant. This is why the SPIVA result 0 categories with a majority of active managers outperforming over 15 years is not surprising to anyone who has read the arithmetic of active management. It is the predicted outcome, confirmed by the data. What would be surprising is if the data showed something different. If I stopped here, I would be telling a one-sided version of a story that has genuine nuance on the other side. The data is not saying that every active fund underperforms in every period. It is saying the average active fund underperforms over the long term, after fees. That leaves room for several real scenarios where the argument for active management is legitimate. The first is less efficient market segments. The SPIVA data is most damning for U.S. large cap equity, the most analyzed, most liquid, most professionally covered segment of any market in the world. In this category, the probability of an active manager having genuine information advantage over the market is nearly 0. The data for small cap funds, international emerging market funds, and certain fixed income categories shows meaningfully lower underperformance rates. In less efficient markets where information is harder to obtain and price discovery is slower, skilled active managers have a more credible claim to sustainable edge. The data supports their case in those specific categories, at least over shorter time horizons. The second is tax loss harvesting in direct indexing. Some sophisticated active strategies, particularly direct indexing accounts that hold individual securities rather than fund shares, can generate systematic tax loss harvesting benefits that offset a portion of the fee disadvantage. This argument is specific to taxable accounts, requires accounts typically above $100,000 to $250,000 minimum, and depends on the investor's tax rate and the specific market environment. It is a real but narrow benefit that applies to a minority of investors. The third is performance persistence, or the lack of it. The SPIVA Persistence Scorecard, which tracks top-performing active funds over consecutive periods, consistently finds that past outperformance does not predict future outperformance. Of the top quartile active large-cap funds in any given year, essentially none remain in the top quartile 4 years later. This matters because it means the active fund selection problem, how to identify the funds that will outperform before they outperform, is nearly impossible to solve with historical data, which is the only data available when making the choice. Let me close with what 30 years of data is actually saying. Index funds win on cost every year, guaranteed, regardless of market conditions. They win on performance over every time horizon long enough for that cost to compound, which the SPIVA data confirms across 25 years of measurement. They win on persistence, because the past performance of active funds does not predict future performance, making the selection of a future outperformer essentially indistinguishable from guessing. And they win on structural mathematics because the average active dollar must earn less than the market return after fees. Not because active managers lack skill, but because the arithmetic of markets requires it. What active management has in its favor is a genuine argument in specific, less efficient market segments, a narrow tax harvesting benefit for large taxable accounts, and the emotional appeal of feeling like someone knowledgeable is watching your money. That last one is real, but does not show up in the performance data. The framework that the evidence supports, for your core, large-cap, long-horizon portfolio, the part of your investing life where the 30-year compounding math matters most, the data argues for low-cost index funds. For smaller sleeves in less efficient markets, or for investors with specific tax situations that benefit from direct indexing, the conversation is more nuanced. But nuance at the margins does not change the direction of the evidence at the core. Here is the question worth sitting with tonight. Look at every fund you currently hold. Find the expense ratio. If any of your core holdings, particularly U.S. large-cap equity, is above 0.20%, that number multiplied by 30 years of compounding is the real question. Not, is this fund good? Is this fee justified by the evidence on what it is likely to produce over 30 years? Drop a comment below. Are you currently holding index funds, active funds, or a mix? And if you're holding active funds, do you know the expense ratios? I want to see what this community is actually invested in right now. Subscribe for a new personal finance video every week. See you in the next one.